Something just broke. Something they didn't see coming. The central banks thought they had it all figured out. They thought their coordination would solve the problem. Instead, they just triggered the biggest silver shock in decades. Ladies and gentlemen, I'm here to tell you what really happened in the last 72 hours. What you're seeing on the surface, the price movements, the headlines, that's just the beginning. What happened behind closed doors, in the emergency calls between Washington, London, Frankfurt, and Tokyo, that's the real story. And it's a story of complete system failure. The Bank of Japan moved first. At 3 a.m. Tokyo time, they announced an emergency liquidity injection into their commercial banking sector. 2.7 trillion yen. The official reason? Stressed commodity exposures. But here's what they didn't tell you. The stress wasn't coming from oil. It wasn't coming from copper. It was coming from silver. Mitsubishi UFJ, Japan's largest bank, had been running a massive silver carry trade for 18 months. Borrow cheap yen, short expensive silver futures, pocket the spread. It worked perfectly until it didn't. When silver started breaking higher, their risk management systems began flashing red. By the time executives arrived at their offices, automated margin calls had already drained their commodity trading accounts. Sumitomo Mitsui wasn't much better. Their derivatives desk had been writing naked call options on silver to institutional clients, collecting premiums while betting the price would stay contained. When silver gapped through their strike prices, they faced unlimited losses on positions they never hedged properly. The Bank of Japan received emergency calls from 6 major banks within a 4-hour window. The message was identical. Without immediate liquidity support, they would be forced to close their commodity trading operations by market open. When Japan's banking sector faces coordinated failure in precious metals markets, the central bank doesn't ask questions. They print money. Japanese banks had been quietly accumulating massive short positions in precious metals futures. They thought they were hedging against yen devaluation. They thought they were playing it safe. Instead, they walked into a buzzsaw. When silver started moving higher over the past month, those positions turned toxic. The margin calls started flooding in. The banks couldn't post the collateral. So the Bank of Japan stepped in. Emergency intervention. Print the money, save the banks. Standard playbook. But here's where it gets interesting. The moment Tokyo announced that injection, London went into panic mode. The Bank of England had been running their own quiet operation. For months, they've been coordinating with the Federal Reserve on what they called managed commodity price stability. The idea was simple. Use central bank coordination to keep strategic metals from getting too expensive. Keep the green energy transition affordable. Keep the defense contractors happy. But the Japanese move just shattered their entire strategy. By bailing out the Japanese banks, Tokyo essentially admitted that the silver shortage was real, that the price suppression wasn't working anymore, that the physical market had overwhelmed the paper games. London panicked. Within hours, the Bank of England was on emergency calls with the European Central Bank. Then the ECB was calling the Federal Reserve. The message was clear. We have a problem. A big problem. The Federal Reserve thought they could contain it. They thought their repo operations from last week would be enough. $17 billion to keep the American banks liquid. But that was before they understood the scale of what they were facing. This wasn't just about American banks anymore. This was global. The ECB moved next. Emergency facility activation. 50 billion euros for European banks facing commodity derivative stress. They didn't mention silver specifically. They called it broad-based commodity market volatility. But the markets knew. The algorithms knew. When you need 50 billion euros to manage broad-based volatility, you're not managing volatility anymore. You're managing panic. And that's when the real shock hit. The Swiss National Bank, the most conservative, the most disciplined central bank in the world, announced their own emergency measures. 7 billion Swiss francs for precious metals, market stabilization. The Swiss don't panic. They don't make emergency announcements. When the Swiss National Bank steps into precious metals markets, you know the system is breaking. But here's the part that should terrify you. All of this coordination, all of these emergency measures, they're making the problem worse, not better. Every injection, every bailout, every emergency facility is confirming to the market that the central banks have lost control, that the silver shortage is so acute, so dangerous, that they're willing to print hundreds of billions to contain it. The hedge fund community is watching this unfold with a mixture of terror and opportunity. Bridgewater's latest internal memo, leaked to select clients, warns of systemic commodity market failure. They're calling it the end of the paper commodity era. When Ray Dalio's team starts hoarding physical assets, you know the institutional consensus has shifted. BlackRock quietly moved $8 billion into precious metals exposure last week. They're not chasing momentum. They're hedging against currency collapse. When the world's largest asset manager starts questioning the stability of fiat money, the writing is on the wall. But it's not just the Americans. European sovereign wealth funds are liquidating bond portfolios to buy mining companies. The Norwegians just acquired controlling interests in 3 silver mines across 2 continents. They're not investing. They're securing supply chains for post-crisis reconstruction. Think about what this means. The same central banks that have been fighting inflation for the past 2 years just threw that fight away to save their banking systems from a silver squeeze. They just chose liquidity over price stability. They just chose the banks over the currency. And the market is responding exactly as you'd expect. Silver isn't just rising anymore, it's in full breakout mode. The futures market is seeing backwardation deeper than anything we've witnessed since the Hunt brothers crisis. The physical premiums are exploding. Dealers across 3 continents are reporting the same thing. No inventory. Extended delays. Premium bid only. The bond markets are starting to crack. German bunds, traditionally the safest asset in Europe, are selling off as investors realize the ECB's emergency silver interventions mean more money printing, more inflation, more currency debasement. The yield on 10-year German debt jumped 40 basis points in 2 trading sessions. That doesn't happen in stable monetary systems. Japanese government bonds are experiencing similar pressure. When your central bank prints nearly 3 trillion yen to save banks from silver positions, bond investors start questioning the long-term value of your currency. The yen is approaching intervention levels against the dollar, but the Bank of Japan can't defend their currency and bail out their banks simultaneously. Credit default swaps on major European banks are widening. The market is pricing in the possibility that silver-related derivative losses could trigger broader banking sector stress. When CDS spreads on institutions like Deutsche Bank and Credit Suisse start moving higher, the contagion is spreading beyond precious metals into systemic risk territory. But the central banks aren't done yet. They can't be done because this coordination, this synchronized intervention, it's created something they never expected. It's created a coordinated failure. The Bank of Japan needs silver for their electronics industry. The ECB needs silver for European solar manufacturing. The Federal Reserve needs silver for American defense contractors. They're all competing for the same shrinking pool of physical metal. They're bidding against each other using printed money. This is economic warfare by accident. Tokyo prints yen to buy silver. London prints pounds to buy silver. Frankfurt prints euros to buy silver. Washington prints dollars to buy silver. The currencies all devalue against the metal, but the metal keeps getting scarcer. The industrial impact is already starting. I'm seeing reports from supply chain managers across the tech sector. Delayed shipments, force majeure clauses being triggered, production schedules being pushed back. The just-in-time manufacturing model that built the modern economy is colliding with the physical reality of metal scarcity. Samsung's semiconductor division just postponed their Q2 expansion. Apple's suppliers in Shenzhen are reporting silver paste shortages that could delay iPhone production. Tesla's battery partners are scrambling for alternative materials that don't exist. These aren't small hiccups. These are trillion-dollar companies discovering that their business models depend on a metal that is disappearing from global markets. The military-industrial complex is waking up to the same nightmare. Defense contractors need silver for radar systems, missile guidance, satellite communications. The Pentagon's supply chain managers are seeing delivery delays stretch from weeks to months. When the Department of Defense can't get the materials they need, national security becomes a precious metals arbitrage game. And the central banks know this. That's why they moved so fast. That's why the coordination happened in hours, not days or weeks. They saw the supply chain reports. They saw the industrial panic building. They knew they had maybe 72 hours before the shortages moved from paper markets to factory floors. But their solution, the money printing, the emergency facilities, it's accelerating the very problem they're trying to solve. Every dollar, euro, yen, and franc they print to buy silver is one more unit of fiat currency chasing a fixed supply of physical metal. They're creating the inflation they swore to destroy. The arbitrage opportunities are disappearing, not because they're being exploited, but because there's no physical metal left to arbitrage. The London fixes, the New York closes, the Shanghai premiums, they're all becoming irrelevant. The real price is being set in the warehouses. The real price is whatever it takes to get actual silver delivered to actual factories. The COMEX registered inventory dropped another 2.3 million ounces this week. That's not normal profit-taking. That's systematic drainage. Someone with deep pockets is standing for delivery on every contract they can get their hands on. The eligible inventory is holding steady, but eligible doesn't mean available. Eligible means sitting in a vault. Registered means ready to move. London Metal Exchange warehouses are reporting similar patterns. Massive withdrawals, extended delivery delays, premium bidding for immediate settlement. The physical infrastructure that supported global silver trading for decades is being overwhelmed by demand it was never designed to handle. The Shanghai Futures Exchange tried to increase margin requirements to cool speculative activity. It backfired. Industrial buyers just posted higher margins and kept buying. When manufacturers are willing to lock up 10 times normal margin deposits to secure silver supply, you're not dealing with speculation. You're dealing with survival. Swiss vaults, traditionally the most secretive in the precious metals world, are breaking their own confidentiality protocols to warn clients about storage capacity constraints. When Swiss vault operators start talking publicly about their limitations, the scarcity has reached critical levels. This is where the central bank coordination turns into central bank competition. Every emergency facility they announce is an admission that they need more metal than the other guys. Every liquidity injection is a bid for scarce physical supply. They're not coordinating anymore, they're fighting. The Japanese are buying through London, the Europeans are buying through New York, the Americans are buying through Switzerland. Everyone is going around everyone else trying to secure supply before the others figure out what's happening. It's a silent currency war fought in ounces instead of basis points. But the competition is getting uglier. Sources inside the London Metal Exchange are reporting unprecedented activity. Central bank proxies, sovereign wealth funds, government-linked entities all bidding aggressively for the same dwindling supply. The Bank of England is reportedly using intermediaries to outbid European buyers. The ECB is allegedly routing purchases through Swiss banks to avoid detection by American counterparts. This isn't cooperation anymore, this is survival. Each central bank realizes that their domestic industries, their strategic manufacturing capabilities, depend on securing silver supply before their competitors do. The Japanese electronics sector is competing with German automotive. American defense contractors are competing with European aerospace. The central banks are funding a resource war with printed money. The most disturbing reports are coming from Asia. The Bank of Japan isn't just buying silver, they're buying silver mines. Entire operations in South America, Australia, Mexico. They're bypassing markets entirely, securing future supply at the source. Other central banks are scrambling to copy this strategy, but the good mines are already spoken for. And the timing couldn't be worse. We're heading into the seasonal demand surge from electronics manufacturing. Chinese New Year shutdowns are creating supply bottlenecks. The Venezuelan situation is restricting South American mine output. The central banks just chose the worst possible moment to turn on the printing presses for precious metals. China is watching this Western central bank panic with strategic patience. Beijing understands what's happening better than Washington, London, or Frankfurt. While Western central banks compete against each other for diminishing silver supplies, China has been quietly securing domestic production and restricting exports. They're not printing money to chase scarcity. They're controlling scarcity to force others to print money. The People's Bank of China hasn't announced any emergency silver programs. They don't need to. Chinese state-owned enterprises control significant portions of global silver refining capacity. While Western central banks bid against each other using devaluing currencies, China simply turns off the tap. Russian and Iranian central banks are coordinating their own precious metals accumulation programs outside the Western financial system. They're buying silver with gold, oil, natural gas. They're not competing with Western central banks. They're waiting for Western currencies to devalue themselves into irrelevance. India's Reserve Bank just authorized emergency silver imports through government channels, bypassing private markets entirely. When the world's largest silver-consuming nation starts treating precious metals like strategic weapons instead of market commodities, the game has fundamentally changed. The shock isn't just that they moved. The shock is that they moved together, and their solution is contradictory. Print money to fight scarcity, create inflation to manage deflation in industrial supply chains, use fiat currencies to corner hard assets. Every economic textbook says this doesn't work. Every historical precedent says this ends badly. But they had no choice. That's what makes this so dangerous. These aren't reckless central bankers making speculative trades. These are conservative institutions making desperate moves because the alternative is watching their entire banking systems collapse under commodity derivative stress. The silver market just became the most important market in the world. Not because of investment demand, because of system survival. The central banks need the price to stay manageable, but their actions are making it unmanageable. They need physical supply, but they're bidding against each other for it. They need market stability, but they just created the most unstable market in decades. This coordination is failing in real time. The synchronized interventions are creating synchronized failures. When the Bank of Japan prints to save their banks, it devalues the yen and makes silver more expensive for Japanese industry. When the ECB prints to save their banks, it devalues the euro and makes silver more expensive for European manufacturers. They're trapped in a loop of their own making. Print money, drive up silver prices, force more industrial panic, require more money printing. The escape hatch is closing. The physical shortage is getting worse, not better. The industrial demand is accelerating, not slowing. And the markets are starting to figure it out. This isn't a normal commodity squeeze that resolves with higher prices, bringing out more supply. This is a strategic resource crisis that money printing makes worse. The more fiat currency they throw at it, the more valuable the scarce physical metal becomes. The biggest silver shock in decades isn't coming from speculators or hedge funds or retail traders. It's coming from the central banks themselves. Their coordination created the crisis. Their solution is amplifying the crisis. Their next moves will determine whether this becomes a controlled devaluation or an uncontrolled collapse. What happens next? More printing, more emergency facilities, more coordination meetings that create more competition for scarce supply. The central banks just started a race they can't win, a race between their printing presses and the laws of physics. The endgame scenarios are becoming clearer. Scenario 1, controlled devaluation. Central banks coordinate currency debasement to manage the silver shock gradually. Industries adapt to permanently higher input costs. Inflation becomes structural, but manageable. Scenario 2, competitive devaluation. Central banks turn on each other completely. Currency wars escalate, trade relationships fracture. Silver becomes the new oil, with nations hoarding supply and weaponizing scarcity. Scenario 3, system breakdown. The silver shortage cascades through global supply chains faster than central banks can print money to manage it. Critical industries shut down. Electronic devices become luxury goods. The green energy transition collapses under commodity inflation. Right now, we're moving rapidly from Scenario 1 towards Scenario 2. The coordination is failing. The competition is intensifying. The central banks that promise to work together are discovering they have fundamentally incompatible interests. The implications for ordinary investors are staggering. Stock markets are beginning to fragment along commodity exposure lines. Technology companies with high silver content in their products are underperforming. Solar energy stocks are getting crushed as investors realize the green energy transition depends on metals that central banks are hoarding with printed money. Real estate markets in major financial centers are seeing unusual activity. Wealthy individuals connected to central banking circles are quietly liquidating property portfolios to buy physical assets. When central bank insiders start trading mansions for metal, the smart money is sending a clear signal about where this crisis is headed. Pension funds and sovereign wealth entities are receiving urgent guidance from their risk management teams. The traditional 60-40 stock bond portfolio allocation assumes currency stability. When central banks coordinate to debase their currencies for commodity market intervention, that assumption breaks down completely. Insurance companies are facing their own crisis. They've written billions in coverage for supply chain disruption, business interruption, commodity price risk. If the silver shortage triggers widespread manufacturing shutdowns, the insurance industry could face claims volumes that dwarf their reserves. The central banks thought they could manage this crisis with coordination and liquidity. Instead, they've created a multidimensional systemic risk that spans currencies, commodities, manufacturing, and financial markets simultaneously. And physics always wins.